Thank you, everyone. Thank you for joining us today for the retrospective lessons learned from leading investors. Let me introduce our all-star panel. We've got Steve Tananbaum to my far left. Steve Tananbaum, founder and CIO of GoldenTree Asset Management, a big credit investor, as you all know. Afterwards, we've got Emmanuel Manny Roman, who is the new CEO of PIMCO. He took over in November after heading up London-based Man Group. And to my left is Josh Friedman. He's co-founder of Canyon Partners, a hedge fund specializing in distressed loans, corporate debt, real estate, and event-driven equities. He's also an alum of Drexel Burnham Lambert. To my right, we have Bill Ford of General Atlantic, a global growth equity firm that was an early investor in, among other companies, Facebook, Uber, and Airbnb. And last but not least, David Bonderman, co-founder and chairman of TPG, the global buyout firm and the largest that is still privately held. We're going to get some lessons from these leading investors and talk a little bit about what's to come. So the idea here is to reflect back so that we can look forward. And as we all know, a lot of expectations have been priced into public markets and private assets in the past half year since the US election and the past 10 months since the Brexit vote. So we're now waiting for governments to make or change policy so that companies and investors can get some clarity on how best to proceed. So my first question to our guests is the current period reminiscent of or comparable to any other time that you've invested? And Josh, why don't I start with you? You've been in finance since the early 80s, so you get the honors.
I think they think because we've been around a long time, we have insight on this, but we'll give it a shot. I think this period's a little bit sui generis myself. We're at the end of a long period, 30 years of secular declines in interest rates that have driven asset values to levels that we haven't seen before in some respects, whether that's equity multiples, whether that's real estate cap rates being quite low, or whether that's bond yields being extraordinarily low. So that's a little bit unusual. But there are lessons from the past that reflect very much on how to invest in this type of an environment. But it's a little different in the sense that we're also hearing that with tax reform and deregulation, some of the things that the Secretary of the Treasury was speaking about this morning, that we could have another shot in the arm, particularly on the equity side of the ledger. So I look at this and I look at both fundamentals and I try to look at structure of the markets themselves. Fundamentals, a lot of people have borrowed money because it's cheap to borrow money. They've done it based on low rates. They haven't capped their rates. And we also have great change going on in business. So there is risk. There's definitely risk. And on the structural side, I think back even to 1990 when I started my business after Drexel vanished. All of a sudden you had the largest market maker in high yield gone from the market. Well, today we have investment banks basically gone from the market. So when there is a reversal and when there are people who are forced to sell, which could easily happen in a market with interest rates going up instead of down and mutual funds offering daily liquidity, you could be left in that same position, not quite like 1990, but you could be in a position where the market makers are gone, people are forced to sell quickly, and you could have price adjustments that are quite radical. We saw that happen, for example, last year as well. And it wouldn't surprise me to see several other bouts of that as places to be opportunistic. So I think the past is not really exactly analogous to today, but I think there are a lot of similarities in particular parts of the marketplace.
A lot of pockets there. David, I want to get your thoughts as well. Is this comparable to any other period in which you've invested?
Well, history tends to repeat itself in many ways, but there's some secular differences this time which are really important. I don't know how many of the folks in the audience saw Masa Son yesterday when he talked about his vision of what's going on in the next 20 to 30 years and what's happened over the last 20 to 30 years. And I think we're in a change here comparable to the age of industrialization with what's gone on the tech side with the internet and the growth. I mean, if you look at the people in this room, they're all spending money on things that didn't exist 20 years ago in ways that are quite different than a normal. When you overlay the point that Josh made on interest rates, if you think about this, the Bank of England has been keeping track of English interest rates for 314 years. And the last 5 years have been the lowest interest rates in all 314 years. So this isn't something that's just the regular cycle. It's a little bit different. And of course, that's not the be-all, it's not all the end-all. We have these secular changes. But there's an overlay here. We're 8 years into with the longest post-war appreciation. And that means something too. These things, nothing goes on forever, and forever is getting closer than it used to be.
I like that. Nothing goes on forever. And of course, what we've seen since the 80s is that U.S. bonds have been on a tear. The 10-year yield had peaked at around 16% in 1981. Steve, you want to jump in?
Yes. Right now, you don't have a lot of dispersion. So that means the market's complacent. There's not a lot of difference in price from, call it, mediocre quality to better quality. That's going to change. As soon as you have interest rates go up, people are going to force rank. This has been a familiar story, just a different film this time. But on the last several cycles, you get right up before the fall, you basically have low vol, you have no dispersion, and higher interest rates naturally will cause portfolio managers to force rank their portfolio opposed to just buy something because they need to buy something because they're getting inflows. So we think that's going to create a lot of opportunity, and it's actually peculiar to us how narrow the spreads are between good credits and not so good credits.
Right, it's certainly been compressed. Manny, does anyone in financial markets today really have any experience investing in a bond bear market?
Someone in the 70s, and I think we have some of those. I mean, I remember I joined Goldman Sachs in 1987, and you would have thought 1987 was a terrible year being a partner at Goldman Sachs when the stock market crashed. But I remember Peter Fahey saying that this was nothing like 73 and 74, where the market went down by 40%, and then all of a sudden you had no volume, you had the New York City financial crisis, and that started the raise in rates, which led to Volcker, and that was very difficult. And I think that we're all going to be tested if we see an environment where rates go up. That being said, the elephant in the room is that we had a situation where quantitative easing has driven rates at a level which is unsustainable. There's a very good study by Andy Haldane from the Bank of England, which basically showed that rates are too low versus the normal level. Lower rates mean higher asset prices. Higher asset prices means lower return going forward. And that's one of the things that all of us will have to deal with, is that returns are going to be challenging, and they're going to be challenging in nearly all asset classes.
Well, speaking of high asset prices, Bill Ford, you look at companies in their infancy that have tremendous growth prospects. How reminiscent of what we're seeing now, how comparable is what we're seeing now to, say, 1999?
Well, I think there's some parallels and some important differences. And I'll pick up on something that David said. In 99 and also 06, 07, you had a similar environment where equity valuations were extended, fully priced. But I think what's different now is the quality of the companies is so much higher today, particularly than in 99. And just a couple of companies in our portfolio, Airbnb and Uber, these are companies with, and also in David's, companies with billion-dollar-plus revenue still growing 100%. And so we're just seeing a completely different quality, and it may be, as was discussed, we're in a period where the shift towards a truly digital economy is transformative. And so I think there may be more to go, actually, despite the high values.
There may be more to go. All right, well, let's talk a little bit about our investment misses. It's rare that we can get so many immortals on stage to talk about some mistakes that have been made in the past and what they've learned from it. Steve Tananbaum, let me start with you. Renaissance broadcasting is something you've identified as a miss, but it led to some opportunities down the road. Tell us what happened.
Sure. So we weren't the catalyst. What we learned on Renaissance Broadcasting was here was a company, it was in network TV stations, it was going public, 1995. It was consolidating industry during a cyclical upturn. It was cheap, and it was at the right place at the right time. We put in for 25 million for the IPO. They were about 40 million short. It was a relatively small IPO. It got pulled. 2 years later, pretty much the exact same company got sold for 3x. And our lesson learned was if we see good value, be a catalyst to make it happen. So fast forward to 2009, we saw a company called Manalocan, or a structured product vehicle, that had a portfolio of mezzanine CLO debt. And this portfolio was trading at pennies on the dollar, but because you had to buy pretty much 400 million of it, it was not getting a lot of interest. So what we did was we bid for the entire portfolio for 14 cents, and because we were able to be the catalyst, we broke up the structure and sold it a month later for over 40 cents. Another example where we saw a catalyst and a lot of value would be a company like Travelodge, which is the second largest hotel company in the UK, and it was very mismanaged. It was basically a growth story that was predicated on revenue growth, not profitability, and they were running out of money. So we were able to get control of 50% of the debt and change management. And our view was if we had decent management, we could double the profits, and good management, we could triple the profits. We got in good management, tripled profits. So our lesson was, if you see good value, be the catalyst, and it could be really profitable.
Pounce on it. And David
Exactly.
Moderman, let's go back to the mid-90s as well, because you've identified White Rabbit in China as an investment miss. This is 大白兔, right?
Yes, when we were early into China, we opened up our third office after Fort Worth and San Francisco was Shanghai. And one of our first deals was a company called Daibai Tu. My Chinese accent is wanting.
No.
So it's probably unrecognizable to those Mandarin speakers in the room.
It sounded right to me.
Thank you, Scarlet. White Rabbit in English, it was a dominant maker of hard candies, and they're sold on every kiosk throughout China. And it was a great opportunity. Steady and growing cash flow, modest numbers, but steady and growing cash flow. So we negotiated a deal with the city of Shanghai, who owned it, and we were very proud of ourselves. And as soon as the deal closed, the sales volume went over the cliff. Somehow or other, the $100 million sales went to like 9. And so we sent our ace forensic team in, which consisted of one guy who had an office and had a bathtub in his office in the Jingjiang Hotel. It's the only place you could get an office in those days. And we found out that the management team had rented the warehouse across the alley from Daibai Tu. And they were taking the product off the assembly line, of the candy line, and out the back door and into their warehouse and selling it out of their warehouse. So we went to the government of Shanghai and complained about this. And after they stopped laughing, we managed to recut the deal where they gave us our money back, and we promised not to tell how they behaved. That was our first Chinese deal. And what did it tell us? It told us something that we have all since discovered. China is different.
Yeah.
Very well said. Very, very painful lesson to learn that China is different. Let's fast forward a little bit to 2008, because of course we've got the financial crisis. Josh Friedman, you had made a call that subprime mortgage was going to be a problem, and you had made money on that. But when it comes to a lesson learned, you look at market structure as something that was a lesson that perhaps gave you a lot to think about.
Yeah, I mean, half of our P&L in 2007 was on subprime on the short side. But what we missed in 2007, and I think we missed it big, was and today I think I'll talk about remedial action as a result of that, is the market structure and the structure of the balance sheets of our counterparties was unbelievably fragile. So we were concerned about spreads, we were concerned about rates, much as we have some of those concerns today for maybe different reasons, different point in the economy. However, we thought we were seeking refuge by buying an awful lot of first lien senior secured bank debt, much of which was trading at discounts, 90 cents, 85 cents, things that we applied enormously fine credit filter to. We were quite sure we were going to get paid back, et cetera. And then we hedged our book using credit default swaps that we undertook with the investment banks. And of course, we all know what happened, that so many people owned bank debt leveraged 3, 4, 5 times through total return swaps with banks who themselves were the counterparties and were in a great deal of danger with their own balance sheets. So when those unwound, not only did bank debt go from, say, 90 to 60, which is a hell of a decrease for first lien bank debt that's pretty clearly money good, but the hedge that we had the basis risk expanded to nearly 1,000 basis points. So you didn't get anywhere near the protection from hedging. So then, of course, you dial the clock forward another 9 months, and all that debt gets paid off at par, and everything's great. But the problem is we could have gone out of business in between, and a lot of people did. So one of the things that I think it taught us, and it applies today, is you can apply all the work you want on due diligence and on credit research and understanding exactly where you think you're going to end up at the end of the day, but you have to make sure you can get there. So you have to look carefully with just as much diligence and just as much rigor at the structure of the market itself. And the best opportunities are often when you have both a disrupted market and a disrupted company balance sheet. So today, for example, we're very cautious about anything that high-yield mutual funds and ETFs buy, because these are vehicles that offer their clients 24-hour liquidity in securities where you can't get 24-hour liquidity. So if you own the same things they own and they have redemptions, you can get in a lot of trouble. We saw that happen last year. It was the first time we'd seen it in quite some time. The high yield market was down in 15, the beginning of 16 it was down. And then you all of a sudden had people get fearful, and there were for the first time significant outflows. And I think we did a very good job at using that to buy something like 11 billion of paper in that interval. But it was because we were so much more focused this time around on the structure of the market and what was likely to happen there in addition to the underlying securities. We thought it was enough maybe, or at least mostly enough to be great credit analysts, and it wasn't.
So the call was right, but to get there, to wait it out, took some sacrifice. Manny, your lesson learned is also from 2008.
Yep. It's called Lehman Brothers. So every time I feel good about myself, I get up, I have this cold sweat, and I think of Lehman Brothers. So the week before Lehman went under, we had exposure to Lehman, and our exposure actually netted between the US parent and the London subsidiary. And we had every possible bankruptcy lawyer look at this. And the only case you knew about an investment bank having trouble was the Drexel case, which had been pretty orderly in 1990. And we wrongly assumed that we have no exposure to Lehman because our exposure between the parent and the sub is zero. What none of us had thought about is that the US parent got bought by Barclays, and then the London operation and the German subsidiary actually was bankrupt on Monday morning. And I want you to realize what it is to have exposure to someone who's bankrupt. The first thing which happened is the phone doesn't ring. So this is the week where you're not sure that Goldman Sachs is solvent and you worry about AIG. So the world has other things to worry about. So you call the Bank of England and it's like an answering machine. We'll get back to you.
Not a good sign.
Not a good sign. And then slowly but surely, you sort of assess what the damage is, but you have this exposure and this unfunded exposure to a subsidiary where it's totally untested territory. They appoint PwC. PwC has never dealt with anything like this. And you have all sorts of risk and exposure that they have to deal with in a very different manner. Now, ultimately, the most surprising of the whole thing is that all of the creditor got their money back and more, because actually the London subsidiary was totally solvent. And so if you waited, and we did, with an enormous amount of work from the whole community, that turned out to be a very good investment and actually a fine situation. But at the time Lehman went under, you really had no idea. And it could have been that the losses actually were significant. And so I think the lesson here is that whether you like it or not, in terms of credit counterparty and exposure counterparty, you have to be incredibly drastic and assume that things won't work in a way you think they're going to work. And there's a level at which you cut all relationship.
So there, I definitely share a lot of the same experiences. With when Roman was talking, it reminded me that we had a big position in IHAP Applebee's that was a hung bridge from Lehman Brothers, and the whole position got transferred to Barclays on the sale. And what we we're thinking, boy, this is terrible. A position, we have a big position and they own, they're a seller. So we were like, great, we're going to actually, we know that they're a seller. We're going to be able to buy it for half of where we have it marked. So we probably bought it for 25 cents for something that was worth 100 cents. And it was, so our view was, okay, this isn't fun, November of 2008, but it could be really attractive November 2009. So we're trying to think, okay, how do we make lemonade out of lemons? And on a mark-to-market basis, it was ugly, but there was definitely a playbook to do here. I think hearing Josh, what he said was so powerful about the migration of liquidity. And you saw it even last year. You might have 500 people who are going to buy, call it 50 million bonds at par. You may only have a tenth of that amount of buyers at 50 cents or lower. So there's still enough buyers, but it's probably, whether it's 75% fewer or 90% fewer, it's a much smaller universe. And that can happen really quickly. In the case of energy, it happened in just a few months. And it's really powerful to look at the migration and pay attention to that. I think the last kind of lesson that we also shared was we had some hedges, and I think after the fact we realized that everybody was hedging with the same instrument or few instruments. And so, the next time around, in terms of expressing a hedge, we've gone with a portfolio of hedges. So if we think that we're concerned about a European election, it's not just the euro, it's a whole bunch of different tools. So that's going to eventually express what we want to express.
Right, so everyone's not unwinding the same trades at the same time. Bill, I want to move it forward a little bit here because one of your investment misses that you identified was Facebook. So certainly after the 90s experiment in China that David was explaining to us and not linked to Lehman Brothers, Facebook was a good investment for you guys. You did really well. You were an early investor. You made a lot of money on it. What happened?
We did. You're back to the equity side of the room here. But we invested in Facebook relatively early on when they had about 250 million users and had a lot of conviction about how the company was going to develop. And they were very early in their monetization of their very large user base. And it played out pretty much like we had hoped. It went through 1 billion users over the next, let's say, year and a half or so, exponential growth. They began to monetize, became a very powerful ad platform, taking some volume from Google, which was all terrific, and that led to a very successful IPO. And we were in a very good place in terms of our investment. But we did believe that the company had a lot more growth ahead of it, and we were also just beginning to see the transition towards mobile, because most of the revenue up to that point was web-based and not mobile-based. And we ended up, why it's a miss, we ended up selling it probably about a year after the IPO, and we did well, but we left probably 40% IRR on the table since then, and $500-600 million of additional gain. And I think the
this is right before the stock chart went like this.
Yeah, it had gone nicely, and then it went parabolic. And it went that when they really got deep into the monetization on mobile. And the thing that I learned from it is, the courage of your convictions. I mean, we had tremendous confidence in the management team. The user base was very, very strong. It started to move towards where it is today, close to 2 billion users. And the thing that we didn't fully appreciate, or we gave up on too soon, was this move to mobile and how big mobile was going to be as an ad platform. And so I view it as a miss. We were in the right company, right entrepreneur, right place, did well, and then we lost probably a big chunk of the upside. So my lesson I take away to try to communicate to our team is, boy, if you have the courage of your convictions, if this is playing out, and you've got terrific management, stick with it.
Right. Well, courage of conviction is needed for anyone who deals in retail these days because it is an industry that faces massive disruption. I see Gilbert Harrison of Financo in the front row. He wants to hear from our panelists about what's in store for retail. Is it the next big short? Many of you obviously have firsthand experience in retail. David, TPG owned Neiman Marcus for 8 years, owns J. Crew. Bill, you have a stake in Tory Burch, is that right?
Yep, correct.
So this downfall we see in retail, it seems like a very slow bleed as opposed to a quick resolution. David, how do you see it playing out?
Well, retail in the States in particular is on a downswing If you look at mall traffic, foot traffic is down like 7%. It's the impact of the internet. I think most people in the real estate business think that overall retail has been overbuilt. There are more storefronts than the country needs. You've got old-fashioned chains that are still hanging around like Sears and Penny's, which have no real outstanding future, except as collateral for some of Mr. Friedman's loans. Then you've got other businesses like our own J. Crew, which are having a tough time dealing with it. But I think you have to divide retail into several different segments. The guys who are in the most trouble are people who are selling other people's brands.
Like department stores.
Sorry?
Like department stores.
Like department stores. Because you can get those brands on over the internet on many different sites. You can get them in retail stores in many different sites. Guys who have their own brand, like a J. Crew, for example, they'll still have the same kinds of woes, but to a lesser degree because they at least control the trademark, they control the brand, they control the pricing. But the internet, I think, has proven much more resilient and much more important than most of us thought a decade ago when this started to happen and people said, well, nobody's going to buy shoes over the internet. I mean, how are you going to know it's going to fit? Nobody's going to buy fashion over the internet. How are they going to know what's really on the runway? But it's turned out that people will do all of those things, and the guys selling over the internet have figured out how to make it convenient with free returns, Amazon Prime, and all those kinds of things. So I think the retail business generically is in for a hard time. It doesn't mean everybody will do badly. If you look at H&M or Zara or the Japanese guys, they've figured out how to deal with just-in-time deliveries and other kinds of things. And you see some reverse engineering, Amazon opening stores, those kinds of things. So it's going to be a mishmash, but it's going to be a tough sector. I'm with Bill here. I'd rather invest in Uber.
Well, are there comparisons to be made with energy, which was last year's kind of industry that everyone's watching, Josh?
Well, I think energy is interesting because I think energy is something very simple. Well, actually, I do think there are some analogies because I think that both retailing and energy experienced fundamental changes that are irreversible. In energy, I think the extraordinarily high prices that were essentially cartel-driven brought out a new technology called fracking that lowered the cost curve. And initially, we really didn't invest in distressed debt in energy at all because it seemed to us in almost every case it was the high-cost, not very competitive companies that had debt outstanding that was trading at a discount where the debt was really just a proxy for the oil price. The world has very much changed since because now the cost curve has come down quite substantially and there are a lot of very efficient fracking companies, and if prices go up, new supply comes on the market, and if prices go down, supply comes off the market. So you have a vertical supply curve that's no longer vertical, it's now shaped more like a normal supply curve. And that means the market is subject to more normal dynamics as opposed to the extremities that happen when you have a very vertical supply curve and it's a very vertical demand curve, and slight shifts cause the price to jump up and down like a yo-yo. It's a much more normal market today. And the result is that it's created a lot of opportunities for people who service, for in the debt of companies who service those businesses, who may have been a little bit too leveraged to handle the transition, because the transition was extremely painful for some of them, but who have very good and very viable business models where you can invest without taking risk on the underlying commodity. But I think industries like retail, like energy, like media and telecom, are all industries that have had really significant fundamental change.
Structural changes.
Structural changes that will permanently change those businesses. You see the same thing in media where Netflix is hiring every producer they can hire, where transmission and software are the dynamics are changing completely. And when you get, and if you look at those industries, those three, plus maybe add healthcare, that's 40% of the high yield universe. So there's a lot of damage that's going to be done to a lot of credits in that part of the world.
Mr. High Yield King?
One of the industries that was first displaced by the internet, and this was about 10 years ago, was the directory business. Now, comparing directories to retailers, one is primarily a monopoly or oligopoly, which would be the print directories, but there are a lot of lessons learned. This has been an industry for the last few years. Has been a very profitable industry to invest in if you followed a simple formula. Get in at a low price, 2 times EBITDA, and go with managements that only employ digital strategies that have been demonstrative. The instinct and what we've seen over the past 10 years is in the directory business is for managements to say, woe is me, print's a tough business, I'm going to spend a lot of money with no accountability in digital. And some of them, the ones who've done that, have squandered a lot of money and they've been terrible investments, and the ones who've been focused and have been very deliberate have been terrific investments. So what we're seeing in retail is some of that, well, our model's changing, we got to go in a whole bunch of different directions, and those types of companies we think are going to be very difficult investments.
Scarlet, just to tie that to what David said before, the distinction we've been drawing in retail is that, as David said, if you're a seller of third-party product in any kind, electronic marketplaces are going to run rampant through your business, and we've seen that not just in traditional retail, but all other sectors, and so they're really threatened. On the other hand, brands who own product and can master the online world, whether it's e-commerce or even brand building or building new relationships with customers, they actually can win. And I mean, at Tory Burch, we've been growing the e-commerce business 50% a year in a very, very tough retail environment. Wholesale's been dead flat. Our own store growth has been probably sub 10%, but e-commerce has been growing. And so I think the key is for brands is to understand that you've got to have robust digital strategies, and your relationship with customers is going to shift. It's not going to be a relationship built by physical traffic. It's going to be built by having a presence on social media and connecting your customers in a much more frequent basis online.
And what works for Tory Burch may not work for someone else.
Exactly. You have to again, build robust digital strategies that fit your brand.
Well, it's clear that technology is redefining retail. So my question to Manny Roman is, what kind of changes are in store for financial services as we see technology change the shape of this industry?
So I think you're going to have plenty of changes, and let me just list a few. So you have, for any asset management company, one of the things which has changed dramatically in the past 30 years is the way you trade and the way you execute orders and the way you access the market. And so think about the fact that in 1985, you had to actually send someone to the New York Stock Exchange and actually punch a ticket, scream to a specialist, get a price, fill it back upstairs, and that would take 3 minutes. Now you can trade in literally a micro of a second and have really complex algorithm where you actually use artificial intelligence and you execute all sort of orders to provide better prices for your fund and for your clients. And that is literally one of the greatest change in the asset management industry you have seen in quite a long time. And I think that's beneficial to clients. It requires different type of people. It requires different capex from the manager, but this is something which is not going to go away. It may not concern the distressed market. It certainly doesn't concern the private equity market, but for everyone who trades in liquid security, it's a big change. The other thing is that clients and retail clients will want to go digital. And whether it's through robo-advisor, whether it's through touching the managers directly, there is a desire to basically, just like in other industry, have an ability to get the value proposition from the managers with no touch. And there will be some winners and there will be some losers in this. And I think it will require significant investment from all of us to be able to cater to these people. And I'm sure there will be a new entrance in the market who will try to be disruptive and try to deal with customer in a different way than we have. And that is the threat for us, and it's something that we very, very actively think about because it has happened in any other industry, and so why would the asset management be different?
When you talk about significant investment, do you see opportunity for PIMCO to get bigger, to buy other asset managers?
Well, I think that's a different question. I think that on the investment side, I think we need to hire more people, and I think we need to spend capex in R&D. And I always say, if you have the choice to grow organically, it's a much safer way to do it. And I think that all of us at this panel would think that markets are extended, that we're going to see mergers, but they may not be for the right reasons.
Everything's too expensive right now?
I think you have very expensive level of asset classes. It doesn't mean that they're going to go down, but it means that it makes everything much more difficult. And to underpin the value of any transaction, you need to have synergies, which are quite substantial to be able to make 1 + 1 = 2.5 instead of 1.5.
Josh, I know that your roots are at M&A. You started off in Goldman Sachs M&A. At the start of the year, you had mentioned that you're betting on M&A more. It's a bigger part of your portfolio. What do you see in the coming months?
Well, people have cheap currency, and so the volume of transactions is up very substantially. And M&A got very uninteresting for a very long period of time. A lot of the deals looked like, 1 up, 5 down, 1 up, 10 down. That changed a bit in the last administration because the uncertainty of the antitrust approval process created some real calamities for people, AbbVie, Shire, and others. As a result, spreads widened pretty much across the board, but within that universe, there were a lot of choices. So you don't have to pick a lot of them, and there are always some that are interesting. Specifically, we focused on a number of deals where there were mergers, but where there were debt securities as well. So you might have had an investment grade company buying a non-investment grade company so the debt could move up if a deal happened. Or a non-investment grade company buying an investment grade company, you might short the debt because you think it's going down. And there have been a number of opportunities in that area where the risk reward on the debt securities, for whatever reason, dominates the equity. Massively. And you have to be ready to buy right away because with debt you have to buy, as Steve was saying before, it's not always the most liquid market. You have to buy on the day when somebody wants to sell, then you want to buy and you can't buy anymore. You want to sell it, you can't sell it. And you have to be creative and clever about how you do it because these are not perfectly liquid markets. But I think with the very high volume of transactions going on in the world today, there are a lot of transactions like that where you get sort of free optionality in the merger market on debt securities. And so that's where we've been focused.
David, where is M&A interesting to you? What areas of the market, of the economy look interesting to you in terms of M&A?
Well, I think this is a period of time where things are idiosyncratically interesting. And what I mean is there's not a sector here you got to say, I'm in love with this sector. It's not a geography, I'm in love with Indonesia or whatever it is. There are times like that. There are times when the macro overwhelms everything else. This is not such a time. And so we're being pretty cautious here. I wanted to segue slightly under the last topic, if I might, tell you a parable of a company called CoStar, which shows you the kinds of changes that can sneak up on you. 20 years ago, about now, a senior at Princeton came to me in my kitchen when I lived in Washington, D.C., and said, I have an idea. Real estate was dominated by, information providing was dominated by a company called Black's Guide. Probably Gil and a few others are probably here old enough to remember Black's Guide. Once a quarter, it put out information on all the leasing availability for various particular markets. And this young guy, this Princeton senior, came to me and said, there's this new thing called a CD.
The compact disc?
And we could put this information on a CD and update it every week, as opposed to updating it every quarter. And if we do this in the right way and get the brokers to give us the right information, the brokers won't have to have staffs to do it all themselves. So it took about 2 years to convince all the brokers in Washington that they should confederate and back this nascent company, which is called CoStar. And they did that, and Black's Guide ultimately went out of business, and CoStar was sending CDs through the mail, and it expanded nationwide. Then the internet came along, and they said, guess what? We don't actually have to send things by mail anymore. We can download this in real time. And so what happened was all the brokers fired all their staffs, and they began to rely on CoStar, which now has like a $6 billion market cap. It's not a huge company, but it's done rather nicely. And it's had 3 technological sets of changes which have caused the job market to change, have caused the information providing market to change. And we're seeing this, that's a microcosm of what's happening, not just in its kind of business, but in the retail businesses we've been talking about. And we don't know what's going to happen here. The one thing you do know is that it's going to change at a rapid pace, and people who don't adapt are going to be in trouble and are in trouble. And the Yellow Pages example that was talked about a minute is a good example. We used to own the Yellow Pages in Norway, which was a great business. It was a monopoly, but it isn't a business at all anymore.
Scott.
Bill, I wanted to get from you a final thought here on valuations, because in the United States, valuations are reaching new highs. What does this mean for your strategy of investing in growth companies? Do you shift into other asset classes? Does it get more crowded because you've got KKR, Blackstone, private equity firms now entering the space as well?
Maybe two comments, Scarlett. First is that we're in 5 different sectors and 5 different geographies, so valuation cycles often are different in those cases. In the U.S., I do agree that all sectors are elevated right now, and it is a more challenging time to invest. But one of the strengths of private equity is that you can basically hold fire when valuations are extended. And maybe just by way of example, last year we invested $2 billion in 19 new investments, and we divested $4.3 billion, a lot of it through M&A. And so I think one of the powers of our model is the optionality of capitalizing what the environment offers up. And for the last 2 or 3 years, what it's offered up is a better exit conditions and entry conditions.
Interesting.
And on the new investment side, what we have tried to do is be even more discerning about underwriting growth, because our belief is that if you can find the kind of disruptors that have been talked about here that can have significant growth, 25, 30% plus, you can afford, if you're forced to pay a high price or a fully valued price, growth can overcome that in a relatively short period of time. Where I think you're running into trouble is where companies sub 10% growers, full equity valuations, you might be exiting on a lower multiple in 4 or 5 years, and that's where I think the returns will compress. You
talk about holding fire. How much cash do you have on hand relative to how much you normally would have?
Well, we have $11 billion of commitment, so that's put us on a typical investment pace of $2.5 to $3 billion per year. So we're below that pace. But one thing I've talked to our investors about is to say, you don't want us to be pro-cyclical. You want us to be counter-cyclical. So when values are pushed and values are high, that is a time to be maybe more cautious on new investments, but be aggressive on exits. And so I think we've said you'll see those be out of balance over various cycles.
How much dry powder do you guys have, Steve?
We're up. So we look at ranges for where we've been the last few years, and we're certainly in the top quartile in terms of cash, and it's that there is some interesting optionality in terms of hedges in Europe, but for the most part, we've been very event-oriented, and in terms of of most of what we're involved in, and believe, given where we are in the cycle, so we think we're in the 8th year. Typical cycle is 9 years. We're not sure whether the cycle is going to be 15 years, 9 years, 10 years, but what we do believe is, looking at places like Australia, where they've had 25 years of growth, that the last 10 years you've had drawdowns of 20%. In the U.S. in 2015, late 15, 16, there was a drawdown of 20%, and there were terrific opportunities. So we think by keeping cash, values are clearly stretched, dispersion's low, that, like what Josh was saying, a lot of the event-oriented situations are the best risk-adjusted returns, and we think in the next 24 months we'll get better opportunities.
There's this debate between hard and soft data. It's come up time and again over the last couple of months. The survey-based data shows the economy is doing great. It's going to take off soon. The hard data seems to come in lighter than expected. There's some misses there. Manny, when you look at the divide there, what indicators do you follow? Or are you looking at alternative sources of data?
Yeah,
scraping news stories?
Yeah, we're looking at a lot of different things, but I think our view is that the soft data look much more like the hard data than people would like to. And at the end of the day, our assumption for growth is that you're going to have, something like 2.5 in the US, and it makes us cautious. And to come back to the last question, just like Steve, we're cutting risk. We think there'll be better opportunity, and it is the time to hit single and make sure that you don't take outsized risk versus the opportunity. But the data are showing just that. And I think one of the things which kind of comes back to other panels outside of this discussion is none of us really understand what automation does to wage inflation. It puts enormous pressure for the years to come in terms of job markets, in terms of labor prices, and we don't fully understand what it's going to do.
Except that it's distorting the data, maybe.
It's clearly distorting the data, and this is why you had, I think, very low inflation for a very long time.
And one source of that automation, some might say, is all these passive investment vehicles that have become very popular of late. So I want to get into the passive versus active debate a bit here. Manny, PIMCO recently published a paper showing that bond mutual funds, active ETFs, outperform their passive peers, more so than on the equity side. Can you tell us a little bit about that?
Yes, I mean, it's a very straightforward story. We all know that active equity managers have had a tough time beating the benchmark. And the numbers are pretty consistent, and there's a whole series of reasons. One of them is fee, the other one is turnover, the third one is anchoring buyers, the fourth one is lack of diversification. But we know equity managers underperform the benchmark. At fixed income, it's simply not true. Fixed income manager beat the benchmark, and PIMCO being one of them, on a 1, 3, 5, and 10-year basis.
Why is that?
For a lot of reasons. One, you have non-economic actors. Think of central bank, think of insurance company, think of pension fund, who buy fixed income for other reasons than you and me. That's reason number one. Number two, you have a biodiversity in terms of instrument, where all of us here can go between government, corporate, mortgages, and the biodiversity, for example, of the mortgage market is so big that this is a real source of alpha. And so the reality is, you look at the data, 65% of the fixed income managers have beat the benchmark over the past 10 years. And this is something that sort of dropped out in the dialogue because everyone is so focused on equity managers. And so we're taking a stand and basically saying, just look at the data. Please look at the data.
Steve, you're nodding.
Yeah, no, agreeing with everything that Roman said. A couple of other qualities for why bonds are tougher to replicate in a passive strategy. Transaction cost,
Yeah.
are just higher. And then second, off-index investments. There are many billion-dollar issuers who just aren't in the indices, and that's a real opportunity, and they've been a very large source of value.
The turnover of the Barclays aggregate is 10 times the turnover of the S&P 500. So just to replicate, you are going to churn your portfolio just chasing the benchmark.
If you focus on the more distressed sectors within the bond markets, this is something that's not going to be replicated by an index. It simply can't be, and the returns are, it's not even close in that sector of the market, and for reasons that are fairly clear. First of all, it requires a high level of interaction and activism to manage your investment. You might be litigating with your aggressive private equity sponsor, you might be negotiating with the other debt categories. There's a lot of complex covenants and other things, collateral, who gets what, how is the capital structure changed. This is the ultimate sort of custom-tailored part of the market. It's not an area that fits within indices. And it also is particularly subject to people who buy and sell for reasons that aren't necessarily economic. For example, if you're involved in a distressed situation that is bank debt and CLOs owned the bank debt, they're simply not allowed to own the equity coming out of that bankruptcy. So at some point they're going to sell before it turns to stock. And it's not because they think the valuation is a good, bad, or a different valuation. Commercial banks have capital charges. People in our industry frequently like to talk about how smart they are because they did X, Y, and Z, and how the seller's not that bright. The seller has completely different constraints usually and is behaving exactly the way someone in our seat might behave if he had those same constraints. So you try to find situations where there are forced sellers. The mortgage market was a good example. You had RMBS securities and hundreds of billions of dollars worth of securities that were, in fact, over $1 trillion of securities that were investment grade securities. They were only allowed to be held in those accounts because they were investment grade. And when they were downgraded, people sold. They didn't really have a choice about the price. They're price takers in the market. But you had massive disparity of sellers versus buyers. It was a relatively new non-investment grade market, so that it was an easy one to play. And you could either say, okay, I can see the disparity, I'm going to buy it, or you could say, okay, I see the disparity, and also I'm going to do a lot of work as well, and really understand the stuff, and maybe you'd last longer in the category. But I think in those areas where there's extreme balance sheet change, upgrading and downgrading, you get a lot of that non-economic behavior, and it's not replicable by an index fund, and I don't see it being subject to that kind of replication.
And we're certainly not seeing that right now. Yet, when we talk about passive investing, David Bonderman, a lot of people say that it owes its success to the macro environment we're in. We've got persistently low interest rates, a resilient bull market. Is that why passive investing does so well?
Well, obviously, persistently low interest rates have had an impact on the markets, both positive and negative in an investment sense. It's driven prices higher. On the other hand, it's made your capital go a further stretch. But listening to this, it strikes me there's a reason that private equity has been the highest yielding asset class for the last 3 decades. And that's because guys in the bond business, the guys in the debt side, or even in the public markets, have relatively fewer tools to work with. You can buy, you can sell, you can maybe litigate in cases, you can be like Bill Ackman and make noise. That's the limit of what you can do unless somebody cooperates with you. If you own the company, you can make management changes. You can be patient. You don't have to worry about quarterly earnings. All of those kinds of things lead you to make more rational decisions. You're not forced to sell something because it's not investment grade anymore. You're not forced to, and you don't get in this debate about passive versus active. Of course you're active, and that's the whole point of the business. And so the results have been that the asset class has outperformed all the other asset classes, and you see the growth of this business. And in fact, as this business gains liquidity with the now people making a market in secondaries, you're going to see more dominance for the private equity world because you don't have to be locked in anymore. So Bill might want
Well,
to
just
add
picking up on what David said, I strongly agree. And there's, just to amplify on it, two big things that have benefited us. One is our ability to make volatility our friend. We capitalize on volatility, upside volatility and downside volatility. And the other is duration. So many investment asset classes, duration is just telescoped in. You know, our ability to go long duration, you know, I think probably David's firm TPG and General Atlantic probably about the same 5-year average duration, but the ability to hold 7, 8, 9, 10 years if necessary to drive change, that's even more differentiated now than it was 5 or 10 years ago versus other asset classes.
All right, we have about 6 minutes left, so I want to turn now to the Trump administration and the tax policies that they have proposed. Just enough time for us to get through all of it. What is the risk of skyrocketing U.S. debt under President Trump? Is that a concern that you are starting to position yourself for, Steve?
Not really, because this is an opening salvo. It's not going to be at 15%. We think that it's still uncertain. I do believe that the markets short term will not pay attention to growing debt and will zero in on it as soon as interest rates go up, because each 1% when you get to 100% on GDP will be, will be 1 for 1. But I think that it's just too early, Scarlet. And as we've seen, whether it's the ACA or other, initiatives or that Trump has proposed, it goes through a lot of mutations.
Yes.
Overall, though, I think that whether it's trade or tax, that there's some efficiencies, particularly on corporate tax rates, that I think would be positive. I think on trade, there are some win-win scenarios for the U.S. And their trading partners, and maybe just win for the U.S. on the trading partners. So, I think those are positive if they can get enacted. Clearly, the noise out of China seems to be pretty constructive, that they can get something that will improve the deficit and potentially be a win-win for both sides.
Manny?
I think there is pressure on rates. I think that the Trump trade was to be long equity, short rates and long dollar. One has worked, and the two other one have been very painful. Rates went from 2.2 to 2.7, and then have come back down. And the reality is, rates and the curve are also dictated by supply and demand, and by foreign investors, and also by an economic prospect, which is not only driven by tax reform. And so I think markets price all these things pretty efficiently. It is very, very hard to have an edge in terms of where you think rates are going. And so I think the market is telling you that the package will be moderate. And I think you have reason to think that the market is more right than not.
I wonder, though, if Trump does get rid of private equity's ability to deduct interest expenses from their portfolio's companies' taxable income, doesn't that hurt leverage? Won't that be a problem for the private equity business model? Steve?
Short answer is yes, but it's just so. I don't believe that's going to happen. I think it's very complicated to get enacted, and so I think that. But the short answer is yes. If it does happen, I just don't think it is going to happen.
It's so far off from what the current form is right now, the one-page proposal. As we get ready to close out, Treasury Secretary Steve Mnuchin is attending the conference. I actually saw him on the Bloomberg set a few moments ago. I know that, Manny, you have a link to the Treasury Secretary. His father, Robert Mnuchin, was the one who gave you your nickname. Is that right?
That is correct. I started at Goldman Sachs, and Steve's father was Bob Mnuchin, who had 3 careers. 1 being a great Goldman Sachs partner, 2 being a great bridge player, 3 being an absolutely awesome art collector and art dealer. And he looked at me and said, "I can't pronounce your name. We're going to call you Manny." And so I became Manny because of Bob Mnuchin.
And the name stuck.
The name stuck.
Given that, what's the one piece of unsolicited advice that you would offer the Treasury Secretary? Is there one?
Think outside monetary policy, think about the labor market, and think about structural changes. And I think the point that Mike made yesterday at dinner, which is that the last time the US built an airport was 20 years ago, when China built at the same time 75 airports. At some point in time, there are other things to care about than monetary policy, part of it being CapEx and what this country runs on.
All right, so say goodbye to monetary policy. Let's think ahead. David, what about you? Is there a piece of unsolicited advice you would give the Treasury Secretary?
I'm not sure I even give them solicited advice. But one observation, which is these guys are attempting radical reform in a system which makes any kind of reform very difficult. And they're promised, almost surely they have promised more than they can possibly achieve. And one of the risks, I think, to the markets is the markets are sort of pricing in a tax reform bill. And I think if you had to bet dollars to donuts, you'd bet that there wouldn't be a tax reform bill. So the advice to the Treasury Secretary would be get what you can, and the perfect is the enemy of the good.
How about you, Bill Ford?
I would say support the innovation economy and start by rolling back the regulatory burden on small business, which has grown dramatically over the last 10 years. Couple that with tax reform if we can get it done, and I think you'll really stimulate economic growth and a better recovery.
And Josh Friedman.
I would agree with Bill's comments completely, and I would say stay calm, reach across the aisle wherever possible, because I think the country could use it, and Skype with your kids every night.
Skype with your kids every night. Do you see any evidence of him reaching across the aisle right now? Or starting to, at least?
I think that Steve's a pretty calm and patient and accommodative guy. He's never been an extreme guy, and I think we're in this unnatural position right now where the default emotion is for everyone to retreat to his own corner, and I think Steve has the ability to be someone who can get us back to a more workable type of government.
All right. I want to thank our panelists, Steve Tananbaum, Manny Roman, Josh Friedman, Bill Ford, and David Bonderman.
Thank you.